I look forward to working with you. As you know, we've had a excellent relationship, but we want to do something that will even it up with respect to trade. I think it's something that's actually very easy to do.
So the real question is a real resolution to the trade war finally in the works? That's the question that everyone's been asking since the G20 summit in June, where President Trump and Chinese President Xi agreed to a temporary truce, as well as renewing their talks. What might it mean for the economy and financial markets going forward, as well as for everyday investors like you? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. Now, as you probably know, I was at a sideline meeting at the G20 Economic Summit in Japan just last month that President Trump and China's President Xi reached a new truce in the US-China Trade War. Now, while the two sides agreed to keep current tariffs in place, they also agreed not to raise tariffs any further and to resume negotiations toward a new equitable trade agreement. Wall Street, of course, celebrated the news with a rally that briefly took both the S&P 500 and the Dow to new record highs. And that spike came on the heels of the stock market's best June performance, literally since 1938. Although that came after its worst May performance in a decade. So what exactly can we expect now that there's at least a hint of progress in the trade war, one of the market's biggest sources of worry and volatility for the last year? We're going to be talking about that today, as well as some of the other factors that could influence markets and the economy in the second half of 2019. Joining us today will be Michael Lee, a market strategist and portfolio manager at Altium Wealth Management.
Regardless of where the trade deal plays out, I don't think we get a rate raise until after the election. So what I would hope is that the economy keeps chugging along and that we accelerate into next year.
Along with Anthony Sekar, he's a lawyer and the founder and president of Providence Financial Group.
The reality is we're in the longest bull market this country has ever seen. And just from a purely common sense standpoint, nothing goes up forever.
But first, let's review the origins of the trade war, which really began as a war of words. It was a year ago in May that President Trump famously tweeted, quote, "Trade wars are good and easy to win," close quote. Long before that, Donald Trump had made tough talk about trade a big part of his presidential campaign. And right from the very start, there was little argument amongst economists or politicians about the need for actually addressing the U.S. trade imbalance and renegotiating some of the past trade deals that helped create it. A country's trade balance, as I've explained before, is the difference between the monetary value of its exports and the monetary value of its imports. A positive trade balance is known as a trade surplus. This is where exports are greater than imports. A negative balance, of course, is the opposite, and that's called a trade deficit. At the start of 2018, the United States trade deficit stood at $566 billion. This indicated that the U.S. was importing hundreds of billions of dollars more in goods and services than it actually exported. So again, the motivation behind the president's efforts on trade was never really disputed. It was the president's approach to them that, in essence, has caused and continues to cause controversy, as well as a lot of nervousness on Wall Street. We'll be talking about this coming up in just a bit. His approach is focused almost entirely on efforts to fix an unbalanced tariff system, a system in which other countries impose larger tariffs on our products than we do on theirs. Now, a tariff, as you probably know, is essentially a tax or a duty charge. And if, for example, we have to pay a 20% tax to export a product, but only charge a 2% tax to import the same product, that's obviously a big financial advantage for the other country. President Trump's effort to rebalance the tariff system has involved slapping new tariffs on imports from many countries. But obviously his main target has been China. And of course that, as you might well know, is with good reason. As we've discussed before, China has a long and well-known history of taking advantage of the unlevel playing field in international trade. For example, the country has long been suspected of suppressing the value of its own currency to make the prices of their exports more attractive to buyers from other countries. It's also infamous for gaining a competitive advantage in trade by paying its workers incredibly low wages and investing little to provide them with good or safe working conditions. Ultimately, China is known to practice mercantilism, an economic policy that prioritizes trade advantage and pursues every single competitive edge to get it. Its mercantilist tactics have been well documented over the years and also include worker subsidies, restrictions on foreign investment, and of course, high tariffs. So, while the need for addressing trade imbalance and dealing with China's mercantilist practices was never really disputed, getting into a full-blown trade war with our largest global economic competitor was simply not an approach favored by most economists, or by many of the president's political rivals. And it still isn't popular with a lot of individuals. Most economists would argue that trade wars are, in fact, neither good nor easy to win, and that there is more downside than upside potential for everybody involved in that trade war. That means for consumers, for businesses, the competing economies as a whole, and the financial markets. And we'll be talking about this also coming up in just a bit. But where does the current trade war stand now, just a few weeks after the G20 truce? And what have been some of the major impacts of it? We'll talk more about that coming up in just a bit. And that's where we want to welcome our next guest, Michael Lee. He's a market strategist and a portfolio manager for Altium Wealth Management. Michael, thanks for joining us today.
Thanks for having me.
So I'm going to ask you this first question, quoting President Trump, just a little bit tongue-in-cheek. So tell me, in your opinion, are trade wars easily winnable?
Well, if you're the United States of America and you have a massive trade imbalance with virtually every other country in the world, yes, they are. It doesn't mean it's without cost. It just means that they're easily winnable.
Now the question, though, is, in this case, what's it going to take? What is it going to take for us to negotiate a truce to this trade war with the Chinese government?
Well, what needs to happen is China needs to save face. So China's in a situation right now where they have a dual deficit. So we get up in arms over our 3 to 4% fiscal deficit here in the U.S. of GDP. And then we also have a massive trade imbalance, but we're a free and open market. China is not a free and open market. They now have a structural trade imbalance because they need more goods from the rest of the world than they're selling, in terms of raw materials. So, China has printed somewhere along the lines of $30 trillion worth of their own currency since 2001. And as a result, their currency is worthless to the rest of the world. So if you're 15% of the world's GDP, yet only 1% of international transactions is settled in your currency, what does that say about you? So China desperately needs direct foreign investment. And what tariffs do is they crush investment. And what we're trying to do from a defense standpoint and from a manufacturing standpoint is take the global supply chain out of China, and it's working. So, we've already, quote unquote, won this trade war. For a truce to come, China needs to save face. So it's my opinion that the deal that was supposed to happen a couple of months ago is ultimately probably not until sometime next spring as it gets closer to the election, that something will be announced. But China needs to emerge from this saving face.
Yeah, and the biggest place, I think that's, to me, the biggest sticking point, in addition to saving face and pride and all that, is this whole intellectual property issue. I mean, do you ever think we're really going to fix that with the Chinese?
Well, we have to. And anybody talks about tariffs or taxes, the $10 to $20 million worth of cost to our economy. China has been stealing, according to the U.S. Trade Representative's office, close to $300 billion worth of intellectual property from the U.S. for the last decade plus. So if you think about that cost to the economy, I mean, it's come to a situation where it's at a head. And China can keep running their domestic economy for a while, but at a certain point, it's going to come to a head. So without verifiable ways to hold them accountable for them to stop stealing our intellectual property, I don't know that we'll get a trade deal. However, like I said before, I think those are in place. China just needs to be able to save face when they're announcing it. So you need to put some window dressing on the deal that I think was going to go through there before. Because remember, in the long run, it benefits everybody if, to quote the president, a big, beautiful deal comes from this.
Now, in the minute or so we have left, tell us about how the Federal Reserve is reacting to all this. They said there's all these cross currents. Our economy's strong, but there's all these global cross currents that they're concerned about. A recent statement from Jerome Powell says that the next move will be to lower interest rates, striking a very dovish tone. If we didn't have this trade war, do you think that tone would be the same, or do you think maybe they'd go back to more of a hawkish stance?
No, I think you hit the nail on the head there. I think if you look around, every other nation in the world does everything they can to subsidize manufacturing, and so that people on the lower level of education can make a meaningful wage, because otherwise you get massive social strife, which I believe is the reason why the election in 2016 went the way it did. So being the fact that rates are negative for a lot of places across Europe and a lot of our competitors in manufacturing, and China will just print money until the end of time to subsidize their manufacturing, we're no other choice. We have no other choice other than to keep rates low. There are some downsides to this, but if it works in the manufacturing, you're balancing long-term risk with near-term risk.
Sure. We need to leave it there for now. We need to take a commercial break. We'll be back in a minute. Stay with us. We'll be back here on The Income Generation. I'm David Scranton, and we'll see you in a minute. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Now, as I mentioned, reducing the trade deficit and renegotiating unfair trade deals, particularly with China, was one of the president's campaign promises. But it wasn't until just about a year ago that he had an opportunity to really begin taking action on that promise. In March of 2018, President Trump imposed tariffs on $50 billion worth of Chinese goods, targeting 1,300 items, everything from steel and aluminum to batteries, airplane parts, and flat-screen TVs. Less than 2 weeks later, China responded by slapping tariffs on 128 American products, ranging from aluminum and airplanes to cars, pork, and soybeans. The dispute then escalated from there, with each country one-upping the other and steadily increasing the amount of goods affected by the tariffs. In all, the U.S. imposed 3 rounds of tariffs last year on more than $250 billion of Chinese goods. China struck back with tariffs ranging from 5 to 25% on $110 billion worth of U.S. products including chemicals, coal, and medical equipment. A truce was agreed to last December, but it collapsed in May, and the U.S. raised tariffs on $200 billion of Chinese goods from 10% all the way up to 25%. China again retaliated with more tariffs on $60 billion worth of U.S. goods. The U.S. began planning another counterpunch, but then came the G20 summit in June, where the latest truce was reached in a side negotiation between President Trump and President Xi. The two pledged to reignite trade talks and to hold off for now on imposing new tariffs upon each other's imports, although existing tariffs will remain in place. Now, as I mentioned earlier, one of the goals of imposing tariffs is to make U.S.-made products cheaper than imported ones, giving shoppers an incentive to buy American with the goal of bringing down our international trade deficit. As for how effective the strategy has been so far, the data is actually mixed. In the first quarter of 2019, the U.S. trade gap with China narrowed to $80 billion compared to $91 billion in the same period last year. Yet according to a new report by the U.S. Commerce Department, the U.S. trade deficit rose again by 8.4% in May to its highest level in 5 months. Now, while U.S. exports in May totaled $210.6 billion, up $4.2 billion from the previous month, that gain was outpaced by a faster rise in imports. They reached $266.2 billion in May, up $8.5 billion in the previous month. The trade deficit with China specifically was at $30.2 billion in May, an increase of more than 12% over the previous month, and this according to the Commerce Department. Now, of course, the trade deficit is only one potential measurement of winning or losing a trade war. And President Trump has claimed as recently as the G20 meeting that the U.S. is, quote, winning big in the ongoing dispute. So far, many economists do agree that the battle has hurt China more than the United States. However, they, along with many business leaders and investors, actually worry. They worry that a long-lasting standoff between the world's two largest economies could result in lasting damage, not just to both countries, but to the entire global economy. Now, as you know, the U.S. stock market experienced record levels of volatility last year, and much of this was driven by these fears over the impact of the growing trade war on various sectors of the U.S. economy. But how serious have those impacts really been so far? And how much more serious might they get if the current truce crumbles and the trade war escalates again? We'll be covering that coming up in just a bit. And now we're back with Michael Lee, market strategist and portfolio manager for Altium Wealth Management. So, Michael, thanks for sticking around. And all right, you think the Federal Reserve is taking the right tone. So what happens? Tomorrow we have a trade deal and everything's good. At that point, does the Federal Reserve still lower interest rates? Do they keep them level? Do they start raising interest rates again? What do you think would be the right move at that point? Should we strike a trade deal, boom, with a snap of a finger?
Well, you know what, Dave, I'd say regardless of where the trade deal plays out, I don't think we get a rate raise until after the election. So what I would hope is that the economy keeps chugging along and that, we accelerate into next year. And one thing that's no one's really talked about is all the hiring that's going to go on along with the census. So I do think there's some stimulative effect that'll come from that government spending next year that'll take us kind of to the next level. But I'm a little bit skeptical that we'll actually get a rate cut because I don't think you and I are aware of how little are alone in being aware of how little tools the Federal Reserve has left. I mean, what do you think they'll do if there's a meaningful slowdown in the economy? What's left?
I know. But if we did somehow miraculously, boom, snap our fingers, wake up tomorrow morning, there's a good, solid trade deal, then at that point you think for the next year or two would be correct to assume that you feel like the stock market is still got some more upside potential with that trade deal in place for the next year or so?
Well, look, I think the rates remain muted. And remain low. The 10-year Treasury is going to be somewhere between 190 and 220. And while it sits there, and you have the S&P 500 trading at 16 to 17 times forward earnings, that's not expensive by any means. The long-term average for the S&P is about a 15, and in times of the great economies, in 1999 we got up to 25 times. So there's, the market in theory could go much, much higher from here.
Now let's look at the opposite. Let's say that you're wrong. Your and my optimistic together proves to be wrong. We don't get a trade deal. It doesn't happen. And we end up going up to, 500 billion, tariffs on 500 billion of goods. what does that mean for the financial markets? The Fed is going to continue to, in that case, they will cut rates probably to stimulate, as you mentioned earlier. But what does it mean for the stock market at that point, for investors?
Well, I would say you get some volatility, but I'm a buyer on any of those dips. The problem that these tariffs create is future investment, but already you're starting to see a lot of Fortune 500 companies making future investments outside of China and moving factories outside of China. That'll be far more devastating for them and for the rest of the world than it would for the U.S. And as rates stay low, U.S. stocks, S&P 500, still probably your best place to put money to work.
Okay, so you've got people who are members of the income generation, those of us over the age of 50 who are either retired or within 10 years or so of retirement. How do you protect them from this increased volatility? I know you could buy on the dips, and that's a great offensive tool, but defensively, how does LTM Wealth Management protect them from the volatility and the downside?
Well, we're very focused on asset allocation, and you got to make sure that regardless of where rates are, you have a high quality portion of fixed income in your portfolio, because on any sort of panic, and especially if rates go down, you're going to get a nice offset with the increase in value from rates going down. It's a very difficult environment to generate income, as it has been for years. But again, while this 10-year treasuries are hovering around 2%, there's a lot of high-quality dividend stocks out there, AT&T, for example, where you can pull yourself off a nice yield. And if you can withstand a little bit of volatility, you can make yourself 4 or 5% from just from the dividends there. And that company's going to be here 10 years from now, regardless of tariffs or trade or the Federal Reserve.
15 seconds. I know there's no average or no typical, but let's say I'm your, quote, average or typical 65-year-old on the brink of retirement. What percentage of my money, as a general rule, should I have in fixed income?
Well, it totally depends on your risk tolerance and how much income you're going to have to generate off the portfolio. Obviously, if you're risk averse and you need a lot of income, upwards of 70. And if you don't need the money from that portfolio for a long time, maybe as little as 30.
Okay, so between 30% fixed income and 70% fixed income, depending upon how conservative and aggressive you are and depending upon how much cash flow you need, which makes sense to me. So Michael, we're out of time, but thank you so much for being on the show today. I really appreciate you being here.
Thanks so much, David.
We'll be back in a moment here on The Income Generation. I'm David Scranton, and yes, we'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
So far, the US-China Trade War has been similar to a so-called Mexican standoff, although Mexico really had nothing to do with it. Except, according to many experts, the guns have been pointed, have the potential to do lasting damage to the largest economies in the world, and to the global economy overall. So what does the data itself tell us about what damage, if any, is being done so far? Well, let's look at some numbers from just before the last escalation in the standoff, which occurred back in May. In the month prior, consumer and industrial activity in both the U.S. and China slowed. China's retail sales grew at their slowest pace in 16 years in the month of April, and its industrial production was more than 3% lower than the month before. U.S. retail sales slid 0.2% in April, down from a 1.7% gain in March. Car sales fell 1.1%, while electronics and appliance sales lost 1.3%. Meanwhile, U.S. industrial production, which reflects total production of factories, utilities, and mines, also fell 0.5% after a 0.2% gain in March. So How much does the trade war have to do with any of this, or with other emerging data that suggests U.S. economic growth might be slowing? Well, the answer is clearer in some sectors of the economy than in others. For example, auto sales and manufacturing are among a handful of industries that have taken the hardest hits from the trade war so far, and are likely to get hit even harder if it continues. Last year, China increased tariffs on U.S.-made cars entering the country from 15% to 40%, and this was in response to new U.S. tariffs. While China consumers mostly buy Chinese cars, some U.S. automobiles like Tesla are still getting hurt. The automaker first raised the price of its Model S and Model X cars by $20,000 last July after a new round of tariffs, but then rethought that and slashed prices and decided to just absorb the difference. Now, China also lies at the heart of the complex global automotive supply chain. This means that U.S. producers spend more on parts from China when they're taxed at a higher rate. Carla Belo, president of the Center for Automotive Research, has said that she believes tariffs and quotas on cars and tariffs and quotas on car parts will not make American automakers and suppliers more competitive in the global market. Instead, it can have the effect of increasing prices for U.S. consumers, even if they buy an American car. And this, of course, is due to the higher cost of imported parts that are used in U.S. production. Another industry especially vulnerable to the trade war is the technology industry, particularly chip makers and electronics manufacturers that depend on China for sales. These are companies like Nvidia Corporation, Micron Technology, and Intel. Apple has so far been able to escape tariffs on its Chinese-assembled phones, but the trade war has already had an impact on the iPhone maker's earnings by adversely affecting the Chinese economy. A fight for technological dominance actually is one of the issues at the heart of the trade war, and it's an area where China isn't likely to pull any punches. While China's tech imports from the United States aren't enough to match Trump's tariffs dollar for dollar, a Bloomberg report from last year suggests the country has other tactics that it could use, such as imposing new taxes and adding regulations on U.S. companies, essentially slowing the approval of deals or encouraging citizens to boycott American products. The other main industry feeling the brunt of the trade war so far has been agriculture. China is the fourth largest agricultural export market for the United States, with exports of agricultural products to China totaling $9.3 billion in 2018. This according to the U.S. Trade Office. Now, traditionally, China has been the largest importer of U.S. soybeans, but last year Chinese officials imposed a new tariff on the product. American soybean farmers were hit hard, and they're left with enormous stockpiles that they simply couldn't sell. Now, as we mentioned, all of this was largely responsible for record levels of stock market volatility last year, as well as the latest escalation of the trade war and an uptick in volatility back in May. Now, as I also mentioned, the markets rebounded again in June and through early July. Not surprisingly, of course, that rebound has been heavily hyped by much of the financial media. But what exactly does it mean in the bigger picture? And how might the trade war and other factors continue to impact the market going forward? This coming up in just a bit. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, and there is a safer way investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession.
Visit theretirementIncomeStore.net to connect with a local income specialist. Request your free digital income kit, including an advanced copy of David J. Scranton's latest book, The Retirement Income Story.
Now it's time to bring in our next guest, Anthony Sekar, great friend of the income generation and a very good friend of yours truly. He's a lawyer, but we won't hold that against him. He's the president and founder of Providence Financial Insurance Services in Woodland Hills, California. Anthony, thanks so much for being here with us today.
Thank you for having me, David.
So you just heard Michael Lee talk about his thoughts about what's going on with the trade war. And he believes the whole reason the Federal Reserve has taken this dovish tone is because of the trade war. And if it weren't for the trade war, if we had a resolution tomorrow, boom, trade war is over, front page of the LA newspaper, I believe that's the LA Times, if memory serves me correctly, that we wouldn't be talking about lowering rates. Do you think that's true?
Well, I think there's some truth to it. I mean, Jerome Powell has just been speaking for the last couple of days in front of the House Finance Committee, and he's been asked multiple times in multiple different ways what are the biggest factors of them lowering the interest rates and striking that dovish tone. And he has pointed back to the trade wars a lot. But he's also pointed back to the fact that the world and global economies are slowing down a little bit. And he's pointed back to the fact that right now, money is, according to the markets, expensive, which is why we have an inverted negative yield curve. And so there's a lot of factors, and he won't point to one thing. He keeps it all generic, but he has talked about one of the biggest concerns is being the uncertainty with regards to world trade. So I don't think it would change tomorrow if that's what would happen, but I think it would. It may lift the possibility. I mean, right now they're talking about a 50 basis point cut. I think that would change if there was certainty to the trade war.
Sure. That's a really big number, 50 basis points. So
that's huge.
Oh, all right. So you think that it's I guess an environment where we probably should cut then. But solution. What are the chances we actually get a resolution here? I mean, you heard Michael Lee talk about the fact that the biggest issue with China is they need to save face. Are we ever going to get this intellectual theft issue covered? This is the issue that the president seems to be pushing so hard for. And I know that you're sitting there on the left coast right now in the LA area, so you need to be careful what you say in case anyone's in earshot. But assuming it's just us talking here on Newsmax TV in the minute or so we have left, tell us, what do you think this is going to happen? Are we ever going to reach the president's goal of fixing this intellectual theft problem?
Well, now you're asking me to speculate. So the answer is I don't know. I can't imagine it going on forever. I think it's a part of the, Trumponomics and the political, sword that he's yielding to try to, get country to bow down to us. I mean, look what he did for Mexico, right? And using tariffs for something that was not even tariff related.
So bottom line then, assuming nobody's in earshot in the LA area to listen to you, 30 seconds left. Is he right? Is the president right? Is a trade war winnable if you're the United States?
I think it is winnable. I think he's done a great job, really. And yeah, if anyone is in California watching me, then you didn't hear this, but I think he's done a phenomenal job. The reality is we've come to some agreement with China at this point, and I think things are headed in the right direction.
I love it. Great, Anthony. Thanks for that, and stick around. We have a couple more segments with you here. We need to take a commercial break. We are here on The Income Generation. I'm Dave Scranton. We're with our good friend Anthony Sekar. Stick with us. We'll be back in a moment. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. One of the most common metaphors used to describe the stock market is, of course, a roller coaster. And it can be incredibly accurate. And if you look at a stock market graph from early 2018 to right now, you realize this coaster ride has been as crazy as anything that Six Flags might have to offer. You'll also realize something else. Even though the Dow and the S&P have both now hit new record highs for the year, neither index is actually much higher at the midpoint of 2019 than it was at the start of 2018. On January 26th a year ago, the S&P closed at 2872 and the Dow at 26,616. On July 9th of this year, the S&P was 2967 and the Dow was 26,702. In the 18 months throughout that period, the market has experienced bouts of extreme volatility, and particularly throughout most of last year, and again in May of this year. So what is the payoff so far for buy and hold investors who've ridden this roller coaster ride and all those nauseating ups and downs? Well, again, you're up just a fraction from where you were a year and a half ago. Does that feel different somehow from the ride you were on before the start of 2018? It could, because in the 14 months between the president's election and the start of 2018, the market climbed fairly steadily. In fact, in 2017, it set an all-time record for low volatility. So what changed? Obviously, one big factor is the one we've discussed today, the trade war. Even though the first shot wasn't actually fired until March of 2018, investors were already getting nervous based upon some of the president's tweets and comments from months earlier, as far back as January of 2018. Another factor, of course, is the Federal Reserve. They were still hawkish at the start of 2018 and talking about moving forward with as many as 4 short-term rate hikes before the end of the year, which they ultimately did. Although the bond market accommodated most of those rate hikes by rising slightly to avoid a flattened yield curve. The Fed's aggressiveness added to Wall Street's nervousness and was sharply criticized by the president. And here's the point. While the stock market's always a roller coaster, for the past year and a half, it's been an unusually wild ride, one resulting in extremely minimal growth, net-net, for investors who've hung in for this ride. In a way, it's like a miniature version of a long-term secular bear market cycle, which experienced extreme volatility over many, many decades, only to bring buy and hold investors right back to where they started, with zero net growth. And that's why I believe making the switch from growth to income-based strategies is so crucial in a long-term secular bear market like the one I believe we're in now. With actively managed income-based strategies, you're investing in vehicles designed to protect your money from volatility and to provide reliable income at competitive rates regardless of market conditions. And with a third major market correction of between 40 and 70% still probable based upon historic evidence, the sooner you make that switch, the better. Now it's time to bring back my good friend Anthony Sekar, president and founder of Providence Financial Insurance Services in Woodland Hills, California. Anthony, you gave us a great lawyer answer last time. You said, now you're asking me to speculate. And that's a typical way that an attorney starts to answer a question. So I expect nothing less from you. But thanks for sticking around. I'm going to flip the argument now on you, okay? The market seems to be holding, seems to be doing well, even before we heard from Jerome Powell just over the last few days. And that's with this trade war. So if we open up the newspaper tomorrow and it says, you know, we've resolved the trade war in a way that's favorable to the United States, does that mean we have another good, strong year of the stock market ahead, in your opinion?
You know, I don't think so. The reality is we're in the longest bull market this country has ever seen. And just from a purely common sense standpoint, nothing goes up forever. Our U.S. economy right now is shrugging off bad news and also good news. It hasn't been fundamental at all. I don't see why all of a sudden the stock market becomes fundamental the moment there's a fundamental reason for it to start growing again. I think there's problems ahead no matter what happens with the trade war.
So you're basically saying that right now the markets are all acting emotionally, and because it seems like there's good news, the market goes down, there's bad news, the market goes up, that these things seem to be not linked. It's almost like, okay, trade war is done, now the market's forward-looking, and if they have nothing positive to look forward to other than that, we're kind of in neutral ground, best case, right?
That's exactly right, 100%. And so the reality is that nothing goes up forever. The market's going to have some problems ahead. I don't think anyone can stop it. I think the presidential election is going to have a big impact on it. If Trump doesn't win again, I think there's going to be some massive, massive challenges.
Especially if we get, one of our pseudo-socialist candidates over there on the left in that huge Democratic panel. That'll be really interesting to see where it goes. But we need to leave it there for this block. I'd like you to stick around for just one more if you can. I know you have to run in just a minute. Can you stick around for one more segment?
I'd love to do it.
Great. All right. We're here with Anthony Sekar of Los Angeles, California. I'm David Scranton, and you're watching The Income Generation. Stay with us. We'll be right back. Welcome back to The Income Generation. Thanks for sticking around. I'm David Scranton. We're here with our good friend Anthony Sekar, founder of Providence Financial and Insurance Services in LA, California. Anthony, I'm going to throw you a softball now. You heard Michael Lee talking about bonds. I threw a question at him, and most market strategists, when you talk about bonds, they're all market. And I said, as you heard, I'm 65 years old, I'm on the brink of retirement, how much should I have in fixed income? And surprisingly, he said between 30 and 70% in fixed income, depending upon A, how much income I need as a retiree, and B, depending upon my risk tolerance level. So how do you best determine for your clients how much should be in fixed income versus in the stock market?
Yeah, well, I think it depends on both of those factors. How much income do you need and risk tolerance? I think those both come into play, but I tend to focus more on how much income do you need. Bonds are vehicles, one of a whole universe of options that are designed to give you income. And the nice thing about bonds is you can spend the interest and live off the interest without ever touching your principal. And, if you're invested in stocks or mutual funds, you can't do that. You have to sell shares to get your income. Whereas with bonds, you can live off the interest. So I may be an attorney, but I tend to be pretty simple. And the question is, would you rather sell shares to get your income or not sell shares to get your income? And bonds allow you to hang on to your principal, live off your interest, and protect your shares. So I think that's the most important factor to me.
What's interesting, though, one thing Michael didn't mention, and most market strategists don't, I want to get your take on this, but okay, let's say I didn't need any income. How much of it, in your opinion, really has to do with whether the market's a great buy right now or the market's too high and we want to be conservative? I mean, some component of it somewhere has to do with where we think the market is today, correct? Regardless of somebody's risk tolerance.
In some regards, you're absolutely right. Now, first of all, without going down a bunny trail, most people who say they don't need income really do need income. They're not adjusting for inflation. They're not factoring that in, and they could do things at a different level. But they just don't want to take it because they don't want to see their portfolio dropping. But sure, the market and where we are has a big impact on things as well. I mean, even if you needed no income from your portfolio and you can afford to gamble everything and you're never going to need your money, well, the market's still at record highs. And the old adage is buy low and sell high. And I don't care what age you are, whether you're older, even whether you're younger, why don't we wait for a better time? Let's wait for the market to be on sale and then get back in at this point. So you're absolutely right. It does depend where the market is as to a recommendation.
Anthony, thanks so much for staying for this last segment. Thanks for being on the show once again. I appreciate it. And you stay with us too. We'll be right back here with more on the income generation in just a minute.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
I'd like to thank both of our guests for joining us today for another episode of The Income Generation. But most importantly, I'd like to thank you, our new and returning viewers. Who doesn't remember playing musical chairs? It was fun, but could also be nerve-wracking, especially if you were one of the smallest kids in the circle. You knew your chances of shoving a bigger kid out of the way in order to grab a chair when the music stopped were probably slim. The bigger kids almost always had an advantage. I mention it because musical chairs is another analogy I often use to describe what it's like for everyday investors who remain heavily invested in the stock market, a market like the one we're experiencing right now. With the market basically trading sideways for a year and a half now, and marked by bouts of extreme volatility thanks to the trade war and other factors, it's a classic sign that big investors probably have one finger on the trigger, ready to pull out as soon as the next major sustained market correction takes hold. That, metaphorically speaking, is when the music will stop. And when it does, whom do you think is most likely to get stuck without a chair? Will it be the big institutional investor on Wall Street who has computerized algorithms that can instantly trigger trades on his behalf before the market even opens? Or will it be the everyday investor whose advisor still has most of his clients' retirement savings invested in stocks and stock mutual funds? Unfortunately, I believe the answer is obvious. Why? Because just like in musical chairs, when it comes to stock market investing, the bigger kid always has the advantage. Here's the good news. They can only exercise that advantage if you're willing to play their game, which you don't have to. If you're retired or you're within 10 years of retirement, you probably shouldn't be playing any games at all with your money. Rather, you should be working with the right advisor to create strategies designed to protect your money and to generate dependable income to meet your retirement goals. That way, you know you'll always have a chair and that you don't have to worry about what might happen when the music stops. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.